Good morning, everyone. Thanks for dialing into the quarterly update. We might just wait a couple of seconds for a few more attendees to join. Sometimes it takes a moment for everyone to tick on through. Okay, great. I can see attendees joining now. So welcome to the June quarter update for the Hamilton 12 Australian Shares Income Fund. I'm Richard McDougall on behalf of Jason, who is presenting today, and of course the entire team. We're delighted that you could join us for the quarterly update webinar. Before I hand over to Jace, just the usual disclaimer that we cover at the beginning of these presentations. Any recommendations made during this update, please consider or take as general advice only. So what that means is we're not taking into account your personal financial circumstances when recommending the fund. Please keep that in mind. We'll also circulate the deck post today's webinar, so please do take some time to read the disclaimer that's included in the deck. Just the usual housekeeping. The June quarterly distributions are due to be paid and statements sent tomorrow, so you should expect to see that in your account if you're elected to receive cash distributions tomorrow evening. For those investors who have elected to reinvest their units, those units will be issued or were issued rather on the 1st of July at the June 30 ex-distribution unit price. All statements, of course, are available via the client portal. If you haven't yet registered for access to the portal, please jump onto our website, hamilton12.com, and you can navigate your way to the login and registration process, which is all self-service online. Of course, if you're having any trouble, please reach out to us at clientservices@hamilton12.com and we will look after you. And for the presentation today, there is a Q&A panel as part of the Zoom functionality. So please just submit your questions during the presentation and we'll either cover those during the presentation or at the end. And if we can't answer your questions, we'll certainly come back to you individually or to the group when we circulate the recording and the slides this afternoon. So without any further from me, I'm going to hand over to Jace to run through the presentation. Thanks, Jace.
Hi, folks. Welcome from me. Excuse me. We always start these quarterly presentations with a review of our investment objective. In fact, there's two investment objectives. One investment objective is to generate long-term after-tax returns for Australian resident investors in excess of our benchmark. And the benchmark is the S&P ASX 200 franking credit adjusted daily total return index superannuation, which is a bit of a mouthful. That is an index compiled by Standard & Poor's of the 200 largest stocks in Australia by market cap. That includes the benefits of franking credits for Australian resident investors and assumes a 15% tax rate on dividend income and assumes no taxes on capital gains. So we aim to earn returns on a after-tax basis, assuming a 15% tax rate that exceed those benchmark returns. Secondly, we aim to provide income. This is a fund which invests only in stocks that pay relatively high franked dividends compared to other stocks in our investment universe, which is the approximately 500 stocks in the All Ordinaries Index. And so we aim to provide high income for investors. So it's designed for investors that have a preference for income over capital growth. And so we aim to earn high income inclusive of those imputation tax benefits. You'll see that we use a systematic approach to investing that mirrors the approach taken by our own index. What does that mean? There is a fund of which your money is invested, and there is an index that began being compiled in September of the year 2000. The fund began in September 2022. And you can think of the index as a theoretical portfolio that is constructed following a set of rules that tilts the index towards stocks paying high franked dividends. The fund makes investments that approximate the portfolio composition of the Hamilton 12 index, but not precisely. I say not precisely because we try to avoid trading too much in stocks that are relatively illiquid, because that incurs more transaction costs than trading liquid stocks. And we don't try to trade unnecessarily, which means that we don't try to shift into one stock and out of another stock merely because the index says, well, in theory, this stock is marginally better on a risk-reward basis than another stock. Because again, that incurs transaction costs and price impact, which erodes total returns for investors. So we have a theoretical portfolio, the Hamilton 12 index, and we have an investment fund that on average approximates the holdings in that index, tilting towards that index on a continuous basis. So our investment thesis is twofold. First of all, there is empirical evidence that stocks that pay high franked dividends in Australia are no more expensive than an equivalent stock that either pays no dividends or pays dividends that don't have franking credits attached. Or in other words, if you buy stocks that pay franked dividends, you receive the franking credits without paying a premium for those franking credits. And the reason that occurs is because stocks are traded by a whole host of investors. There are some investors, Australian superannuation funds, Australian charities, Australian individual investors, Australian corporations that receive full value from imputation tax credits. But there's a whole host of other investors, like international investors, like investors that are trading purely on the basis of anticipated capital gains. There are market makers who are trying to earn intraday a small spread between the bid price and the ask price. There's a whole host of other investors that don't care at all about imputation tax credits. And it turns out that the aggregate impact on prices amongst the trades of all of these investors means that prices of Australian listed stocks are set such that there is no price premium for stocks that pay a franking credit versus a very similar stock that does not pay a franking credit. The second part of our investment thesis is that stocks that pay high dividend yield on average historically have earned higher returns than stocks that don't pay high dividend yields. And the idea is that there are some investors in that pool of investors in the marketplace that systematically make a mistake and they pay too much for stocks on the anticipation that their investment projects funded by having low dividends or negative dividends, so doing capital raises, that they think those investments are going to do really, really well. Or in other words, there is a bias towards high prices for growth stocks and low prices for value stocks. And that persistent bias in investor psychology seems to flow through to these high dividend yield stocks on average, generating higher returns than low dividend yield stocks. And we have a systematic process for trading towards those high dividend yield stocks. We don't simply rank stocks from highest dividend to lowest dividend. We consider all the dividends that we think the stocks are going to pay over their entire life. And we do a valuation of all the stocks to try to work out, well, which stocks do we think on a relative basis, on the basis of their projected dividends, are relatively better value. We manage risk in the portfolio, of which holds approximately 100 stocks, by allocating the portfolio across stocks in different industries and companies of different size. So we think about companies on a small cap versus large cap basis, with a cutoff of about $2.5 billion of market value of equity. And we look at 11 industry cohorts to make sure that our fund holdings and our index holdings on an approximate basis mirror those of the benchmark, the ASX 200. I'm going to show you some metrics on that data coming up. This table, which contains a lot of numbers, shows a breakdown of fund returns since inception and over shorter time periods. The fund became operational on the 9th of September 2022, and in the 3.8 years since that point, the fund has earned total returns for investors who benefit fully from imputation tax credits and don't pay taxes to the tune of 13.5%. And that's the number about halfway down on that slide on the far right-hand side under the heading grossed up returns. And some investors in our fund meet that category. They might be investors with a superannuation fund in a pension phase. They might be other tax-exempt investors like a foundation. We have another benchmark for which to evaluate our performance, and that is investors facing a 15% tax rate. So that's typically in a superannuation fund in the accumulation phase. And since inception, those investors accounting for 15% tax on their dividend income have earned after-tax returns of 12.1% per year. Those numbers, 13.5% for investors facing no taxes, and 12.1% for investors facing a 15% income tax rate, have exceeded returns on the benchmark. The corresponding returns on the benchmark have been 11.6% per year and 10.8% per year, which you see at the bottom part of the slide in the second bottom row of numbers. There's another group of investors we consider. Those investors face a 30% corporate tax rate. Now, when we compute after-tax returns for this cohort of investors, we include a capital gains tax estimate. So we include taxes on capital gains of 30%, just like we include dividend income taxes of 30%. And we still account for the tax benefits of imputation tax credits. For those corporate investors, since inception, their total returns have been 9.7% per year, relative to 8.1%, which those investors would have earned if they could form a portfolio which approximates the ASX 200. So investment objective one has been achieved to date, and that is to earn after-tax returns which exceed that of the benchmark. Investment objective two is to earn high income. And if we look at the after-tax dividend yield, roughly halfway down this particular table, the after-tax dividend yield since inception has been 9.1% for investors facing no taxes, 7.7% for investors facing a 15% tax rate, and 6.6% for investors facing the corporate tax rate of 30%. Those yields exceed benchmark yields to the tune of 4.1%, 3.4%, and 3% respectively. So to date, investment objective two has been obtained. But that's not all we want to do. We don't want to just earn higher returns than the benchmark. We have to manage risk, because even though returns have been high relative to benchmark since inception, we want to make sure that that is not coming simply because the portfolio is exposing investors to higher risk, because that could lead to higher chance that in future returns fall below the benchmark. Okay, so let's look carefully at risk. The simplest way to think about risk is to look at the standard deviation of returns. Standard deviation being a statistical measure of dispersion. We can take the monthly returns on the fund and convert it to an annualized standard deviation. And that's an estimate of roughly 2/3 of cases relative to the mean will be one standard deviation above average and one standard deviation below average. So if you think about a typical equities return of about 10%, and you look at the standard deviation of 12.7% on the left of this slide, that means that if you were expecting to earn a 10% total return, there's roughly a 2/3 chance that in any given year, the return could be as high as 23% or as low as -3%. If you think about more extreme returns and think about two standard deviations, there's about a 95% chance that you'd have returns which are two standard deviations above average, or in other words, returns as high as 36%, or returns two standard deviations below average. So if you had a baseline return of, say, 10% and fell 26% below that baseline, you would have a -16% return. So we could say that roughly there's a 2 in 3 chance that returns, given this sample of data, which runs for about 3.8 years, would in the future be somewhere in the range of -3% to +23%, and roughly in 19 out of 20 cases, somewhere in the range of -16% to +26%. The key point, though, is that the fund returns have approximately the same standard deviation as the ASX 200. We measured the ASX 200 volatility over the same time period, and that annualized standard deviation is 12.9%. So that means in aggregate, the portfolio has approximately the same overall volatility as the benchmark. However, in any particular period, the returns will deviate from the benchmark because we're holding different stocks. The fund is holding approximately 100 to 120 stocks drawn from the 500 stocks in the All Ordinaries index. The benchmark is holding 200 of the biggest stocks from that index on a market capitalization weighted basis. So the portfolios are different. You can see another figure on this slide here that says the annualized standard deviation of the difference in monthly returns. And that means that in any given year, there is a roughly a 2/3 chance that fund returns would be 4% above benchmark returns or 4% below benchmark returns. And there's also a 19 out of 20% chance, 19 out of 20 chance, roughly, that fund returns could be 8% above benchmark returns or 8% below benchmark returns. So the key point is that in an individual year, there will be deviation of fund returns compared to benchmark returns. But if you have an investment horizon of roughly 3 to 5 years, the probability that those negative returns below benchmark happen consecutively in several of those years starts to wash out. And if you look at the time series of fund returns relative to the benchmark, and if we look back further in time at Hamilton 12 index returns, which have been back tested all the way back to the year 2000, there is typically 3 out of 5 years that index returns exceed benchmark returns, and typically 2 out of 5 years in which index returns fall below benchmark returns. Right? Sometimes it's 4 out of 5 years that returns are above benchmark. On occasion, it's 2 out of 5 years. But the typical pattern that we observe the majority of the time is that in 3 out of 5 years, portfolio returns following our investment thesis exceed benchmark returns. And that's where the 3 to 5 year investment horizon idea comes from. The reason that risk in aggregate approximates that of the benchmark is because the fund is diversified across industries in a very similar way to how the ASX 200 is diversified across industries. So take financials, for example, of which about 20% of financials are the banks and about 13% of financials are non-bank financials like insurance companies. On average, over the last 12 months, ending June 2026, roughly 1/3 of the market value of stocks on the benchmark was in financials, and roughly 34% of fund holdings was in financials. On average, over the last 12 months, if you take basic materials, that includes the resources companies like BHP and Rio Tinto, and non-resources materials companies like chemicals companies, for example, roughly 1/5 of the benchmark was in basic materials, and on average over the same 12-month period, roughly 1/5 of the portfolio was in basic materials. But we can keep going down the spectrum of industry, and you'll see that in most cases, fund composition approximates benchmark composition, but not always. If you take, for example, real estate, fund weight in real estate is on a persistent basis below ASX 200 weight in real estate. And that's because real estate has lots of real estate investment trusts that don't pay imputation tax credits. Fund holdings are typically below benchmark holdings in technology because technology stocks are comprised more of growth stocks in which more of corporate earnings are being devoted for investment projects, leaving less corporate earnings available to pay dividends to investors. So the dividends are not sufficiently high to have high yield, or the dividends are unfranked. So we typically observe an underweight position in real estate, an underweight position in technology, and that is offset by corresponding overweight positions in some of the other industries. The figure of 7.2% for industry active share, that means in aggregate, if you take all of the absolute deviations from fund industry composition relative to benchmark industry composition and sum those differences and divide by 2, that differential is 7%. So that means in aggregate, 93% of the industry composition of the fund mirrors that of the ASX 200, and there's roughly a 7% industry weight divergence relative to benchmark. So the fund is mitigating risk by trying to adopt an approximate industry neutral position. Where the fund does take on risk is in stock selection. On the right-hand side, you can see the average fund holdings for the top 10 stocks in the fund over the prior 12 months. And you can see the relative, the corresponding weight of each stock in the ASX 200. You can see that the fund has had an overweight position in the past 12 months in BHP, National Australia Bank, Westpac, Woodside, and ANZ, for instance, the top 5 holdings. And those top 10 holdings, on average, have comprised 51% of the portfolio. Those same top 10 holdings only comprised 30% of the weight in the ASX 200. So what the fund is doing is taking large risk in terms of its stock holdings and very low risk in terms of industry exposure, which means that the stock active share is 60%. Or in other words, approximately 40% of the fund portfolio on average overlaps with the ASX 200, and approximately 60% of the portfolio deviates from the weights in the ASX 200. A byproduct of our fund portfolio composition is that we have mitigated exposure to other risks that you might think could affect an equity portfolio. So take, for example, credit risk. That is the risk that a company becomes financially distressed. And an extreme example of becoming financially distressed is going into bankruptcy. There's two ways that you can think about credit ratings for companies as a measure of the likelihood of becoming financially distressed. One way is to look at financial ratios. So, for example, a typical financial ratio of a ratings agency like Moody's or Standard & Poor's or Fitch will be to look at a company's debt relative to its earnings before interest and tax, depreciation and amortization, or EBITDA, a measure of cash operating profit. Typically, if a company has debt relative to EBITDA of above 5, that company is a highly levered company and then increases the chance of becoming financially distressed. Well, financial ratings companies like S&P look at a whole range of financial ratios and they assess the likelihood that companies become financially distressed. And they assign letter grades to these probabilities associated with becoming distressed. Based upon financial ratios, the median credit rating of fund holdings is BBB+. In the benchmark, the median credit rating based upon financial ratios is also BBB+. So fund holdings have about the same risk of becoming financially distressed as stocks in the ASX 200. The second way to think about the chance of becoming distressed is to look at how much debt a company has relative to its market value of its stock. We call that a structural, the financial ratings companies call that a structural credit rating. Fund holdings have a structural credit rating of A. The benchmark has a structural credit rating as a median of A-. So approximately the same. So the leverage on a market value basis of fund holdings approximates that of the basis of the benchmark, I should say. Another series of risks you can think of in terms of environmental, social, and governance ratings. Now, ESG grades form no part of the portfolio formation process, right? These grades are a byproduct of the portfolio formation process. And there is pretty weak evidence that picking investments on the basis of their environmental, social, and governance ratings is actually associated with better returns to shareholders. However, the ratings do have some usefulness in terms of being like a measure of risk. If you have poor governance ratings or poor environmental ratings, you are likely exposing your investors to the chance that you have executives that don't act in the best interest of shareholders, or you have executives that make decisions which might prioritize short-term earnings at the expense of either safety or environmental damage. So we don't want that. And it turns out that the environmental, social, and governance risk profile of fund holdings approximates that of the benchmark. Overall ESG ratings as a median of B+ in the fund and B+ in the ASX 200, and they have very similar letter grades across the environmental, social, and governance spectrum. Where the fund does deviate from the benchmark is in terms of dividend payout ratios. You can see over the next 2 forecast years, stocks in the portfolio are expected to pay out 2/3 of corporate earnings as dividends. Benchmark stocks are expected to pay out under 60% of corporate earnings as dividends. The buy and hold dividend yield of the portfolio holdings exceeds that of the benchmark. On a 2-year forward-looking basis, it's 4.5% and 4.6%, which exceeds 3.4% and 3.6% for the benchmark. The buy and hold dividend yield is an estimate of what the dividend yield would be if we took the portfolio today and made no changes to the portfolio over the course of the next 12 months. It's lower than the actual dividend yield on a pre-tax basis that the fund generates, because the fund composition is not static over the next 12 months. The fund will rebalance towards stocks that have upcoming ex-dividend events. That's the date at which shareholders become entitled to the next dividend payment. And the fund will rebalance towards stocks that have relatively higher dividend yield and sell stocks that have comparatively lower dividend yield. So the actual dividend yield observed amongst investors on a pre-tax basis is closer to 6% relative to the 4.5% that you would observe if we made no changes to the portfolio over the course of 12 months. Stocks in the portfolio have comparatively lower prices relative to forecast earnings. You can see figures there at the top of the slide of about 14.7 and 14.2, relative to benchmark PEs of about 17 and 16. So the stocks are trading at lower prices relative to forecast earnings. They earn about the same return on the book value of equity as benchmark holdings. Net income of a company relative to its equity from its balance sheet, that ratio is the return on equity figure. And that figure is approximately 14 or 15% on a forward-looking basis for fund holdings and about 14 to 15% for ASX 200 stocks. So what that means is that fund companies are, in a near-term basis, about as profitable as benchmark holdings, but the companies in the fund pay out more of their earnings as dividends, and they are trading at lower prices relative to those dividends. So the short story is that in aggregate, it appears as though fund returns are relatively high compared to benchmark returns, but not coming at the expense of increased volatility, not coming at the expense of increased credit risk, and not coming at the expense of increased risk on the environmental, social, and governance basis. To look at returns over a longer period of time, I mentioned our index that has been operating on a forward-looking basis since September 2020 and has been back-tested all the way back to the year 2000. If you look at the period since the index went live in September 2020, fund returns on an after-tax basis have been 14.4% for an investor facing no taxes, including a 10% after-tax yield. And if we look at the corresponding computation since the Hamilton 12 fund went live in September 2022, total returns have been 14.4% on an after-tax basis, including approximately a 9% after-tax yield. So we have some reasonable confidence that our investment process, which began with that index going live in September 2020, is likely to generate persistent returns with about the same risk profile that we observed historically. If we look at risk on a much longer period of time, not just returns, you can see that index returns, again, are pretty similar to benchmark returns. On the right-hand side of this part of this slide, in the table, you can see standard deviation, and in the second row, the ASX 200 standard deviation. If we take the monthly returns and annualize those figures over the entire time period, and we look at in grossed up returns on the far right column, the volatility of index returns has been 15.6% per year. The ASX 200 volatility has been 14.5% per year. So again, those numbers, for practical purposes, are roughly the same, right? There's roughly the same risk in the Hamilton 12 index on a back-tested basis as there was in the ASX 200. There's other risk metrics that we look at, maximum drawdown being the worst thing that could have happened from a peak to a trough return. The maximum drawdown for the index was 42.2% in the global financial crisis. The maximum drawdown for the ASX 200 was 49%. And the ASX 200 took 5.5 years to recover until it returned all that money back to investors. The Sharpe ratio is a reward for risk ratio. It shows portfolio returns relative to a benchmark of a risk-free return divided by volatility. So a figure of 0.67 for the Sharpe ratio means that approximately for every 1 unit increase in volatility, portfolio returns earn about 0.7% return relative to the risk-free rate of interest, basically a government bond yield. The ASX 200 Sharpe ratio historically has been a bit lower at about 0.45. The Sortino ratio is a similar ratio to Sharpe ratio, but only considers volatility on the downside, and portfolio returns have exceeded that of the benchmark on a risk-adjusted basis. And finally, we look at upside capture and downside capture. Upside capture shows you the benefits you get from risk exposure when the share market goes up. And you want the upside capture to be a figure above 100%. That means that the share market goes up by 10% and your upside capture is 110%, you'd earn a return of about 11%. You want your downside capture ratio to be less than 100%. That means that the share market falls by 10%, and your downside capture ratio is about 90%, you would expect your portfolio return to fall by about only 9%. So you want upside capture ratio above 1, and you want downside capture ratio less than 1. And that is a byproduct of the fund composition, which tilts towards stocks that are relatively more mature than companies that comprise the benchmark. They're investing for growth. I mentioned right at the start of this presentation that approximately every 3 out of 5 years, index returns have exceeded benchmark returns. And that's illustrated in the chart that you can see on the left-hand side, which shows you index returns on a total returns basis for an investor with a 15% tax rate in the blue bars, and corresponding returns for the ASX 200 comprised by the gold dots. So when the blue bar is high relative to the gold dots, that means index returns exceeded the benchmark. When the blue bar is below the gold dot, it means that index returns fell short of the benchmark. And if you look carefully at the time series, you can see that in most 5-year periods, there'll be 3 of those times when the blue bars are at a level above the gold dots, which means that roughly there's 3 out of 5 years in which the index returns exceeded benchmark returns. The key point is that there is risk in the portfolio that mirrors the index, right? The overall risk is about the same, but there will be periods, typically about 2 out of every 5 years, in which portfolio returns fall short of the benchmark. This is not a risk-free investment strategy, and it's not free of benchmark risk. But on average, we typically observe about 3 out of every 5 years, index returns exceeding benchmark returns. The last thing we always mention in these presentations is some measure of interest rates and economic conditions. And this is just a snapshot. This doesn't influence fund holdings, but we think investors in Australia in particular care a lot about interest rates. They're very mindful of alternatives in low-risk investment products like bond investment products or term deposits that also generate income. So they know what interest rates are. They care about what the Reserve Bank is doing in terms of interest rates and how it affects unemployment and GDP growth, and in particular inflation. And so we like to look at a snapshot of interest rates. So what you can see here is that at the top of this slide, we've got some different measures of interest rates for the most recent month that's available. And we are comparing those rates to what has happened as a median over the prior 4 years. What we can see is that interest rates in general are above what they have been as a 4-year median. That doesn't mean they're high, because we had a period there where interest rates within the 4-year median were a little bit low. Term deposit rates are at about 4.5%. 10-year government bonds are at about 4.7%. Corporate bond yields are slightly lower than they have been over the past 4 years. Home loan interest rates are a bit above their 4-year median, and margin loans people take on to buy shares, they're above their 4-year median at 8%. Fixed rate personal loans are at about 10.4%, almost no change from their 4-year median. So interest rates have been a little bit higher compared to the most recent years. However, those interest rates are fairly typical if you look over a very long time horizon. The Reserve Bank in the recent meetings has increased its target cash rate, which I believe stands at about 4.35% at present. But those increases only get back the level of the RBA's target cash rate that it had for most of 2023 and 2024. So as much as people talk about the RBA having recently increased cash rates, That's only happened because the Reserve Bank pulled the trigger a little bit too earlier in decreasing cash rates in 2025 and had to reverse course and increase them to about 4.35%. The bottom part of this table is showing you Reserve Bank forecasts in its latest statement of monetary policy for some economic indicators. The Reserve Bank has now become quite sanguine about expectations for growth. The Reserve Bank, on an annualized basis, is only forecasting real growth in gross domestic product of about 1.3 or 1.4% per year over the next couple of years. The Reserve Bank is forecasting a slight increase in unemployment, but of concern for consumers and wage earners is that if you look at the nominal wages growth and the forecast change in the consumer price index, those numbers are approximately the same if you average them over the entire 6 years presented in this table, which means that consumers are seeing their purchasing power stay about flat. Their wages are going up only at approximately their expectations for inflation. And so this is what the Reserve Bank cares about, right? If we have too much stimulus in the economy, we'll have high inflation. If we increase interest rates too much, we'll have people struggling to pay their mortgages and we'll have an increase in unemployment. And again, there'll be some hardship. So the Reserve Bank is being very careful to do its best to get the cash rate to a level that generates increased prosperity in aggregate for the economy. And at the moment, the projections are that purchasing power is going to stay about flat for the next couple of years. The very last line is a market-derived estimate of the cash rate. It's not the RBA's projection. It's a number the RBA reports based upon market prices for investors that are making bets in the market for what the cash rate is going to be via futures contracts. So investors in the marketplace are anticipating cash rates to go up from about 4% up to about 4.7% over the next couple of years. All right, so that summarizes the presentation itself, summarizes our returns and our volatility and risk exposure on a number of bases. We're happy with the volatility investors have been exposed to. We're happy with the returns that have been generated, and we're happy with the income that's been generated. And we're doing our best to manage those things going forward.
Thanks, Jace. We've got 4 questions that have come through so far, which is great. I'll just go through these in order that they've come through. First one, you were behind over 3 months. Should I be worried?
Well, there will be many periods in that historical series in which the fund underperforms over a 3-month period. The recommended investment timeframe is to think about somewhere in the 3 to 5 year range, but that is going to be the case for any systematic investment strategy. Any systematic investment strategy relies upon placing many bets that the investor thinks are going to pay off on average. So if we think about a coin that has a bias, so it doesn't have a 50-50 chance of being heads or tails, if it has a 55 to 45% chance of being heads, you want to be betting on that coin flip over and over again. But there will be many instances in which that bet doesn't pay off. We can do all sorts of analogies. If you think about a season for a football coach, if you took NRL coaches and you ranked them by their win-loss ratio, and you took some of the most successful coaches. For Queenslanders, we think of Wayne Bennett as being very successful. If you're in New South Wales, sorry for your...
Phil Gould.
If you're in New South Wales, fine, if you like that sort of thing. We can think of someone like Ricky Stewart as being very successful. Or we can think of the Cleary at the Penrith Panthers as being very successful. But if you look at their win-loss ratios, even those very, most prolific coaches will probably have a win-loss ratio somewhere in the range of 55 to 60% win rate. But you would say, well, that's a very successful coach. So looking at a 3-month window, even though we report it, because investors, do want to know, well, what happened in my portfolio recently? It's not a reliable indicator as to what might happen on average over an extended period of time.
Apologies to our southern friends for no AFL references. So the next question, Jace, which is probably in line with that, is when would you expect the fund to underperform on a total return basis?
Well, the main circumstance in which the fund would underperform on a total return basis is when investors in the marketplace decide on any given day that they like growth, right? That they like growth stocks. One thing that we report on our monthly fact sheets is recent performance of two benchmarks, right? MSCI, a data provider, generates returns on an index of value stocks, that are stocks that have basically low price earnings ratios, and returns on an index of growth stocks, right? That's companies with high sales growth projections and low price earnings ratios. In any given month, the market is going to decide that it's optimistic about future growth, and therefore growth stocks are going to earn higher returns. So there's going to be higher returns to technology companies and healthcare companies of the subset that are investing lots of money for growth. In contrast, there's going to be other months in which the market says, I'm not optimistic about the future. I'm not optimistic about the long-term prospects of these companies making big bets. I'm going to bid up the price of value stocks, and I'm going to sell some of those growth stocks. Because the portfolio is invested in value stocks predominantly, there's going to be periods where the market says, I prefer growth over value, and the fund is likely to underperform. Another circumstance that we have observed is that when you have very sharp increases in interest rates in the broader economy on consecutive periods, there have been periods when dividend high yield strategies have underperformed. That's not something that's unique to our fund. It's not something that's unique to Australia. That's a global phenomenon, right? There has been a few papers written that looked at different markets that say when interest rates increase sharply in consecutive months, right? Several months strung together of interest rate increases, you do see relative underperformance from high yield strategies. That phenomenon isn't greatly understood, though. It's not obvious as to exactly what's driving that relative underperformance, but that is an empirical fact. It could be that investors are substituting one income generating asset for another, but it's not necessarily the case that that's what's driving that result. But it is an empirical fact.
Thanks, Jace. Next question here. Across equity income funds, generally, 12-month trailing yield seems to have been lower this financial year when compared to last year. Why is that?
Okay, so there's a couple of things going on. So first of all, yields in the broader market are lower. Okay, so if you just look at the ASX 200 dividend yield on a pre-tax basis, the benchmark yield has been 3.8% in aggregate since inception. It has been 3.3% in the most recent 12-month period. So what that means in aggregate across all stocks in the Australian market, prices are higher relative to forecast dividends than they were previously. So in aggregate, dividend yields are down. All right. Secondly, in terms of the way we think about dividend yields, we are thinking very carefully about not just short-term dividend yields. We're thinking about dividend yields over the entire life of an investment holding, the entire forecast dividend stream for all companies, and we're effectively valuing all of those dividends. So what has happened is that the portfolio composition has shifted away from stocks that have really, really high dividends in the short term, but not necessarily a high growth trajectory of those dividends, to companies that have high dividend yields in the short term, but have modest dividend growth profiles over the next 5 years. So two parts to that. In aggregate, dividend yields are lower in the marketplace. Prices are higher relative to dividends. And secondly, there is some of those companies, like Fortescue, for example, were paying really, really high dividends in the short term, but at an unsustainable level. And as those dividends have normalized to be a smoother profile and they're not coming down, you're seeing the sort of more normal dividend profile that you can see on this slide.
Thanks, Jace. A couple more. How will the proposed changes to capital gains tax affect my investment in the fund?
Okay, so the first thing to note is that the capital gains component of fund returns is typically much lower than that of benchmark returns. So if we think about the since inception figures to smooth out any short-term volatility of capital gains, the price return component of the fund has been 4.4%, and the dividend yield return on a pre-tax basis has been 6.4%. Those are almost a mirror image of the price return and dividend yield of the benchmark return. So the capital gains component or contribution to total returns in the fund is less than the benchmark, and the yield component is higher relative to the benchmark. So the investors are somewhat immunized from the more onerous capital gains tax regime which is coming forward compared to benchmark, because the actual capital gains being generated are, as an aggregate level, lower than the benchmark. So think about, this first plank as in aggregate capital gains taxes are going up, right? The mechanism how those capital gains taxes are going up is complex. We're moving to an indexation-based system to get a discount in capital gains, as opposed to just getting, for example, a 50% tax discount for an individual investor. But in aggregate, capital gains taxes are going up. But the actual capital gains themselves on a pre-tax basis of the fund is much lower than that of the benchmark. So there's some immunization there. Secondly, in terms of like how investors are individually affected by these capital gains, we are looking very carefully at how capital gains are going to be realized across investments within the fund to try to work out how should we think about optimizing our strategy in terms of whether investors are going to be exposed to risk exposure from the new capital gains increases. That work is in progress. So it's not necessarily the case that we're going to have exactly the same understanding of how capital gains might affect fund returns. That's yet to be determined.
Thanks, Jace. And a final one here, which I'm happy to cover. What is the fund size, capital inflows and outflows quarterly? So the fund at the moment is a button over 35 million, and that takes into account the recent cash distribution that we've just paid out to those investors who have elected to take cash. In terms of momentum, about 12.5 million of that figure has been added in the last 12 months. That's not unusual for a fund of this origin. Typically, as it approaches its 3-year validation phase, typically you will see, inflows increase as you're approaching the 3 years, particularly if the fund has been performing well. We've only ever really experienced 1 month, which I think was around the end of 2024, where we had net outflows in the fund. And that was an existing investor, which was a philanthropic foundation, had to make a charitable payment and actually came back into the fund 2 months later. In terms of the actual quarterly numbers, I don't have those, but I can come back to that particular investor. But as I mentioned, there's been acceleration of inflows in the last 10 months. We've had 1 month where we've had negative outflows, which I think was about $60,000 in total. That is it for the questions, Jace. I think we should wrap it up. We're approaching the hour. Nothing further from you, Jace?
Nothing for me.
Well, thanks everyone for dialing in. We certainly look forward to keeping you updated regularly as the fund progresses. If you have any further questions about today's presentation or about the fund more broadly, please don't hesitate to reach out to us directly or, of course, through the website. For anyone new joining us today, you can request a copy of the information memorandum through the website, noting that the fund is available to wholesale investors only, or certainly speak with your financial advisor who can reach out to us or access us via the platforms that we're available on. As I mentioned, we'll send out a recording of today's session along with the slides, and we'll post both of those on the website as well. Finally, we'd really appreciate your feedback on today's update. If you have any feedback for us, simply just reply to the email that you receive this afternoon, and we'll certainly take that feedback on board. So thanks again for joining us today, and we look forward to seeing you at the next update, if not before. Thanks very much.